Hey traders, and welcome to another episode of Smart Risk. Conducting a professional market analysis can be quite confusing, complicated, and also can be really time-consuming if you don't know which key factors you need to identify on your price chart. In this video, we are going to give you a quick breakdown of how to make it easy. And also, we will explain the basic and advanced ICT concepts about key factors and elements that you need to identify and draw in your price chart. So traders, if that's something you're interested in, please give this video a thumbs up to show your support and subscribe to our channel if you are new. See you after intro. Welcome back traders. Let's get started. So, what are the key factors that we should identify on the price chart? First, we should look for the most recent liquidity sweep areas. 2. We need to detect buy or sell side liquidity resting zones. 3. We need to flag fair value gaps. 4. We should spot order blocks close to the current market price. 5. We should identify premium and discount zones. 6. We need to spot the general outline of the market. So, let's start with key factor number 1. Identifying the most recent liquidity sweep zones. So for that, we must look at the chart and try to find zones where liquidity has recently been swept. If you are unsure of the liquidity definition in places where we can find liquidity, please go through our channel and watch our liquidity and inducement video, which is linked in the description. So, as you can see here, we have this major low. That price has taken out the liquidity which is accumulated under it, with the help of this long wick here, which would be stop orders that have gathered below the low. So, we draw this liquidity sweep zone right here to our chart. The second key factor is identifying liquidity resting zones, which means we need to detect liquidity resting zones on the chart that price potentially may moves to grab them. So here, as you can see, the sell side liquidity is swept by this strong impulsive movement to the downside. So we should identify buy side liquidity on the chart. So we have buy side liquidity right here. Again, we have good liquidity just above this high. Next, we have another buy side liquidity here. And we have an excellent good liquidity zone above this swing high. Now, we have highlighted all of the liquidity resting zones. As you can see, price has taken all of the sell side liquidities from the market, and now we can anticipate that price will rise in response to sweeping buy side internal liquidities that we have highlighted on our price chart. The next key factor, which we're looking for, is fair value gaps. For a better understanding of FVGs, before explaining any definition, we already should know the meaning of inefficiency. So, guys, what is the definition of inefficiency? Inefficiency occurs when there is an imbalance between buyers and sellers on the market, which leaves a disequilibrium that needs to be filled. In other words, if there is a gap within the candles, we call it an inefficiency. So, let's see how we should identify inefficiency in the market. As you can see from the left corner, there is a gap between the candles. We anticipate that price will eventually fill the gap by returning to test the blank space. So guys, we call this phase inefficiency. However, in the right corner candles, there is no gap between the candles, so here, we have no inefficiency. So let's move on to the fair value gap. What is the fair value gap meaning and how can we identify it? Fair value gaps are zones created by inefficiency in the market, and usually appears in a specific zone where there is less trading activity seen and price only has one directional movement. Fair value gaps are a very useful concept in price action trading, and they represent zones where a lot of orders were injected for creating inefficiency in the market. FVGs represent new trading opportunities, especially when coupled with order blocks. Fair value gaps can become a magnet for price in the future to fill the inefficiency as there are many resting orders. We can use them as targets for our entries. So let's see how we should identify a fair value gap. Fair value gaps are formed inside a 3-candle sequence and are frequently shown on the chart as a large candle, which the upper and lower wicks of its neighbor candles do not fully overlap its body. Hence, the fair value gap zone is the area that fills the space between the wicks, which is drawn on the body of a candle. Here, during the price move down, a fair value gap or liquidity gap is created by the lack of buying pressure, which overlaps that part of the move to the downside. The key to identifying fair value gaps is that the gap can only be calculated by taking the impulse up or impulse down candle, as well as the candles on either side of it. Everything else does not contribute to that gap. These packets of liquidity are important and can act as strong entries as the market is drawn to liquidity, which means, when price is planning to move downward, it wants to sweep the potential liquidity zones above it. Thus, FVGs are great areas where the price may rise, and after testing them, may continue to bearish with even more strength. So, let's get into price chart and spot the fair value gaps on our chart. So guys, the current price is here, so we should look above this level for identifying fair value gaps. We have a fair value gap right here. Again, we have another fair value gap here, and we also can identify this zone as a fair value gap. We have got 3 fair value gaps above the current price. That price can potentially come up and hit any of them. And also we have this tiny fair value gap, and also we can spot another fair value gap just here. It is generally advisable to mark up fair value gaps in the vicinity of the current price. Because if we ignore them in our trading system, then probably we might have to endure some losses. So guys, let's move on to the next key factor that we need to mark up in our price chart. We have to identify the 4th key factor on the price chart, which is order blocks near the current price. So let's start with the order block exact definition. Order blocks are very important optimized supply and demand zones that include a large amount of buy and sell orders. When price reaches them, it may potentially change its direction to the opposite way. So let's see how we can identify an order block on the candlestick chart. In the bullish scenario, the last bearish candlestick before the start of a heavy bullish move is detected as an order block. Or the first weak candlestick before a drastic move. However, for having a valid order block, the recent market structure must be broken. The same concept applies to the bearish scenario. So, here in the price chart, if we look a little bit more precisely, we can easily spot this order block where price is hit and reversed from it. As you can see, we also have this perfect order block just near the fair value gap and liquidity resting zone. Let's move on to the next key factor. So, the next key factor is identifying premium and discount zones. What are the premium and discount zones? For having high probability setups, we want price to be in the best areas. To gain probability in our trading, we are using the Fibonacci tool to see if price is in the premium or discount zone. We buy in the discount and sell in the premium. Also, we may use premium or discount zones to find valid order blocks and fair value gaps to trade. For example, if the market is bullish, trading the bullish order blocks that are located in the discount zone would help us to improve our trading strategy and reduce the potential losses. How should the premium and discount areas be drawn on the chart? To determine whether the price is in premium or discounted, we may use the Fibonacci tool by connecting the swing high and swing low of the price. The zone, which is located under the 0.5 Fibonacci level, is known as the discount zone, and also the zone, which is placed above the equilibrium line, is known as the premium zone. These zones are only reliable if impulsive movement breaks the recent structure. For drawing premium and discount zone in a bearish scenario, the Fibonacci tool is pulled from the start of the impulsive movement to the end of it. The same concept applies to the bullish scenario. So, let's add premium and discount zones to our chart. As you can see, we have this bearish impulse movement, so for drawing premium and discount zone, we use the Fibonacci tool from the high of this movement to its lowest point. Then we draw a line from the Fibonacci tool's 50% level. So guys, the zone below our equilibrium level is known as the discount zone, and the upper zone is the premium zone. Hence, whenever price is below the equilibrium level, or in the discount zone, we should be taking long positions. Similarly, whenever price is in the premium zone, which is considered to be expensive, we should be taking short positions. Long positions should not be taken in this area. So, let's move on to the last checkmark. So, our last key factor is analyzing market's general outline. Meaning that we should spot market direction and structures that are created in the market. So, as you can see here, it's obvious that price was in pretty strong uptrend. But right now, as you can see, market structure shift happening here. Because price couldn't make a new higher high, and finally created this change of character by breaking this higher low to the downside. But as you can see, we have a sell-side liquidity here, which is swept by the market. So guys, for me this is a market structure shift and liquidity sweep as well, but there is a high probability that price will go for sweeping the buy-side liquidity before going bearish. As the market structure and character have changed, we can claim that price is generally in a downtrend. But what we want to see here is that price rises up above 0.5 Fibonacci level into the premium zone to allow us to enter into the short position. So guys, now we have added all the key factors to our price chart that we need to analyze the market. You can see that the market structure has changed in the 4-hour time frame, and as a result, we are anticipating a bearish price movement. If you zoom into the lower time frames, you already can see sell-side liquidity has been swept, and in the process of sweeping liquidity, price has generated these three fair value gaps. So, which one is the most significant fair value gap out of all of these three? This fair value gap has more significant for us because, first, it is located in the premium zone, and second, we have a very good liquidity resting zone just below the fair value gap. Since price has swept this sell-side liquidity level, I expect the price to rise for sweeping out this buy-side liquidity level, and maybe continue to move upward till this fair value gap zone. And after filling it, may get reversed and continue to its bearish movement. We can already use ICT trading strategies and patterns to take short positions from this zone as the price reaches the fair value gap. In the upcoming episodes, we will go through and optimize a variety of ICT trading patterns and strategies that will undoubtedly support your trading system and greatly improve your win rate. So keep an eye out for that. That's it, traders. If you enjoyed the video and want us to keep making more videos week after week, please be sure to click the subscribe button and turn on the notifications bell, and also in the comments section, let us know your opinions and tell us what kind of topics you want us to cover. And we'll work our best to create more videos for you. So thanks for watching, and we'll see you in the next episode.